Hello everyone, and welcome back to the Gold TLDR. Guys, did last Friday's market feel absolutely insane or what? Gold smashed right through its all-time high, rocketing to a staggering $4,550. But let's be real, the true MVP wasn't gold, it was its wild little brother, silver. Can you believe it? International silver pumped 10% in a single day last Friday. And that momentum carried right into this morning, blasting past the $80 mark to hit a new historic high of $83.75. That brings the year-to-date gain to a mind-blowing 190%. Looking back, this is basically free money raining down on us. But, friends, listen closely. When the market party is at its loudest, that's usually when danger is lurking around the corner. Even our real-life Iron Man, the world's richest man, Elon Musk, couldn't help but comment on this vertical move. He straight up said, "This isn't exactly a good sign. Why is even Musk getting jittery? Because the hidden risks behind this rally are piling up fast." Here is the bombshell, and it's exactly why I had to rush out this video today. While everyone is still browsing for Lambos over new highs, the world's largest futures exchange, CME Group, has quietly pulled out its nuclear option. According to the latest news, CME is raising margin requirements for gold and silver futures across the board, effective after the close on Monday, December 29th. What does this mean? It means the house is starting to pull in the net. This bucket of cold water could very likely trigger a violent correction for gold and silver, which are currently running hotter than ever. So, before we dive deep, let's get the standard disclaimer out of the way. Everything in this video is just my personal opinion and does not constitute investment advice. Especially with gold and silver volatility going off the charts, leverage is a double-edged sword. Please think for yourself. Manage your position sizing carefully, and for heaven's sake, do not gamble with your life savings. All right, let's get down to business. Let's talk about the most confusing yet exciting part of this rally. Why is silver suddenly acting like it's on steroids, completely outperforming gold? If you look at the charts, you'll see the gold-silver ratio has smashed through the critical 60 level. This usually signals that a strong silver cycle is confirmed. So, what on earth is sending silver to the moon? Here are the 3 core drivers for you. Point number 1, silver's natural high-stakes gambler trait. Compared to gold, silver is inherently more volatile, which is a magnet for speculative money chasing big returns. Right now, there's an extreme imbalance between paper silver and physical silver. What does that mean? The volume of silver contracts traded far exceeds the actual bars sitting in vaults. It's like everyone buying vouchers for concert tickets, but the venue hardly has any real seats left. Once market sentiment ignites, this disconnect triggers a massive short squeeze, pushing prices to unbelievable heights. Point number 2 is solid fundamental support, the explosion of industrial demand. This is where it differs from gold. About 90% of gold is for jewelry or investment hedging, but silver is the king of industrial metals. What are the 2 hottest sectors right now? Solar, energy, and AI. Neither can function without silver. Solar panels need silver paste for conduction, and high-end components in AI servers need it too. This dual-engine demand has transformed silver from a simple precious metal into a tech necessity. Now you see why Musk is worried about silver prices getting too high, right? Point number 3, and the one that actually scares me the most, is the fatal flaw on the supply side. This is key. Did you know that about 70% to 75% of global silver isn't mined from actual silver mines? It's a byproduct of metals like lead, zinc, and copper. This creates a really awkward situation. Silver production doesn't increase just because the price goes up. Even if silver hits $200 tomorrow, a copper mine owner isn't going to overmine copper just to get a bit more silver, because that would crash copper prices. So, data shows 2025 global silver production is stagnant at around 813 million ounces, zero growth. Meanwhile, visible inventory, what we can see in exchange warehouses, is at historic lows. At the same time, massive amounts of physical silver are flowing relentlessly into China and India, the 2 consumer giants. Capacity is locked, inventory is bottoming out, and demand is exploding. It is a textbook supply-demand mismatch. Hearing all this, do you feel like silver could double again? But hold your horses, friends, do not go all in just yet. Speaking of which, I want to ask you guys, do you think this silver run will smash through the $100 barrier, or will it be a flash in the pan like before? Are you holding positions or sitting on the sidelines? Let me know in the comments. Let's discuss this incredible market action. All right, time for a reality check. Let's focus on the potential catalyst that could end this bull run, the CME margin hike. A new trader might ask, is raising margins really that scary? Let me tell you, it's terrifying. Financial history is written in red over this. Think of it like a casino. Originally, you could bet $100 with just $10 in your pocket. Now, the house sees you winning too much and suddenly changes the rules, demanding you put up $20 or $30 to stay in the game. What happens to the gamblers short on cash? They are forced to fold, selling their chips just to stay afloat. This tactic has popped silver bubbles before. Let's rewind to 2011. Silver was going vertical just like now, nearing $50. The result? CME hiked silver margins 5 times in just 2 weeks. This triggered a mass exodus of leveraged funds. Silver prices subsequently fell off a cliff, and countless traders were liquidated and went bust in that crash. Now, history seems to be repeating itself. CME is hiking margins across the board after Monday's close, Dec 29th. The intent is obvious: cool down the overheated market. For those chasing the rally with high leverage, Monday's close is do or die. If you don't have enough margin, your broker will forcefully close your position without mercy. This chain reaction causes a stampede, leading to the most violent drops. So, now that we know the bull versus bear setup, let's look at the technical picture. First, Big Brother Gold. Opening the daily chart, the pullback risk we flagged last Friday is still very real. Even though we hit a new high, 2 ominous signals have appeared. First, gold seems to be forming a rising wedge. Tech analysis geeks know this is usually a bearish reversal pattern, like a car climbing a hill where the slope gets steeper but the engine loses power. The wedge's upper boundary aligns perfectly with the intraday high around 4,550. That means this is a massive resistance level. Second, the RSI, Relative Strength Index, is showing clear bearish divergence. What does that mean? Price made a higher high, but the indicator made a lower high. It signals that bullish momentum is fading. It's like a marathon runner who's still moving forward but out of breath, ready to collapse at any moment. So, if we get a short-term pullback, where do we look? Initial support is in the 4,430 to 4,450 zone. If that floor gives way, bears might push harder, targeting the psychological 4,400 level. Of course, let's not be total doomers. This is a super bull market, and money flow can smash through any resistance. The rejection at the wedge top isn't super obvious yet, and the bulls won't retreat easily. If gold can effectively break and hold above 4,550, it's blue skies ahead, with the next target likely pointing straight at 4,600. Now, let's look at silver. Honestly, silver's current price action defies traditional technical analysis. It's like watching a rocket launch. You can't measure how high it'll go with a ruler. However, this morning gave us a warning sign. After breaking 80, silver pulled back, leaving a long upper wick. This shows massive selling pressure around the 80 mark. $80 is a huge psychological and historical barrier. If bulls can't conquer and hold 80 decisively, we need to be careful. Silver could see a violent correction to fix this overextension. Finally, a reminder. Even though it's New Year's week and you're in holiday mode, the market doesn't sleep. Expect volatility. Besides digesting the CME margin hike, we have 2 major events this week. First, the Fed minutes. These will reveal details on future rate cuts. Any hint of being hawkish or dovish will trigger massive swings in the dollar and precious metals. The other wild card is Trump potentially announcing his Fed chair nominee this week. We know Trump is unpredictable. If he picks someone extremely dovish or extremely hawkish, the market impact will be nothing short of spectacular. So, enjoy your New Year holiday, but keep an eye on your accounts. This week's market walks a fine line between heaven and hell. To sum up, while the long-term trend for gold and silver is bullish and fundamentals are strong, short-term risk is at a tipping point. The CME margin hike is the needle that could pop the balloon. Technically, gold's divergence and wedge top plus silver's $80 resistance are all screaming, don't FOMO, don't chase the high, don't chase the high. If you're long, maybe it's time to take some profits off the table. If you want to short, keep the position small and set a tight stop loss. Because trying to call the top in a raging bull market is like picking up pennies in front of a steamroller, extremely dangerous. That's it for today's video. The financial market never runs out of opportunities, only the capital to stay in the game. I hope you all protect your profits in these last days of 2025. Wishing you a Happy New Year 2026 inches advance, successful trading, and may you make absolute bank. That wraps up today's The Gold TLDR. If you found this analysis helpful, please smash that like button, subscribe, and hit the notification bell. This is the Gold TLDR. See you in the next video. Bye.